What is going on? Happy Thursday. Today we got news that the ECB, the European Central Bank, cut interest rates 25 basis points. We know how the story goes, guys. When the central bank cuts interest rates or continues to cut interest rates, we want to be short the money and we want to be long the right assets. And you know which asset I think is the right asset. After we got this news, we saw the euro fall in price. It fell against the dollar as expected. And we saw European stocks perform very well today. Let's go ahead and take a look at the chart of the Europe 600 index. This is the daily chart. And as you can see, European stocks headed higher throughout the day. And that's to be expected, right? We know that if a central bank cuts interest rates, we're probably going to see these stocks in that jurisdiction perform pretty well during that day or around that rate cut. This is the third rate cut of the year for the ECB, and their deposit rate now sits at 3.25%. And it looks like they're probably going to be cutting more at their next meetings. We'll have to see what happens with events over the next couple of months, but this could be a sign to get out of the euro, right? If they're going to a looser monetary policy, this is probably going to lead to higher inflation, more currency debasement, and in that case, we don't want to be in the money. And when you think about the global macro picture right now, with these wars going on, if we see these wars escalate and we see energy prices potentially rise, this could be an inflationary cocktail, right? With looser monetary policy and rising energy prices, that typically is a recipe for inflation. Now, if we do head into a larger global conflict where more and more countries need to get involved and allocate more resources, this could crash economies around the globe. It could lead to severe stock market crashes. But what do governments do when there are severe stock market crashes or there's fear of a severe recession? They come in and they provide liquidity in some way or another. So if we do go into a larger global conflict, maybe hopefully not a world war type conflict, but something of significant magnitude, and we see stock markets around the globe crash, initially it will be bad for asset prices, but I think we can count on governments coming in and saving their economies, or not saving, but postponing that mayhem, right? Pushing it out into the future with inflation, right? And we'll see the money go down in value and we'll see asset prices head higher. You also have to think, if we do head into a larger global conflict, how are all these governments and countries going to fund their involvement? They're going to have to print money, right? Inflation is the long-term end game, no matter what happens, in my opinion. Now, why did the ECB come out and continue to cut interest rates today? They cut interest rates because they are experiencing economic slowdown over the past 12 months, over the past couple of years, due to these higher interest rates that they've had, and they're experiencing disinflationary forces. Let's go ahead and take a look at a visual here, which shows the inflation rate by their measurements versus their deposit rate. And as you can see, in 2022, they were experiencing pretty high inflation, actually the highest inflation they've experienced in decades. And they started to raise their policy rate around that time, the same time that the Fed started to raise their federal funds rate. As they've raised their policy rate, we've seen inflation come down in Europe, and it's actually come down to around 2%. Again, this is by their measurement, but things are definitely slowing down in Europe. When rates are high, it's difficult for businesses to borrow more money to grow, to expand. It's difficult for people to make investments, to borrow money to invest. It's difficult for consumers, right? It's more difficult to buy a house. It's more difficult to send your kid to college. It's more difficult to take out a loan for a car. So as interest rates rise, we see it takes a toll on both lenders and borrowers, and it leads to an economic slowdown. Europe is experiencing something similar to what we are experiencing here in the United States. Just with the economy slowing, they're seeing more bankruptcies, they're seeing more layoffs, and they're seeing less consumer demand. But another reason why economies in Europe are weakening is that their export market is struggling. When we look at the top exporters in Europe like Germany, France, Italy, who do they mostly export to? It's the United States and China. China is a fucking mess right now. They are having to inject liquidity currently into their economy just to keep things from falling apart. And the United States economy is currently slowing down. We saw that the Fed cut rates at the last meeting because it's becoming clear that we are either in a recession or nearing a recession here in the United States. So as the global economy slows down, there just aren't as many people looking to buy products from Europe, right? To import from Europe. And because of that, a lot of these exporting countries have seen less demand. For example, Germany is one of the largest exporters in the world. And when countries like the United States and China aren't buying, it puts a lot of pressure on a country like that. We're seeing layoffs at companies in Germany such as Siemens and Volkswagen and others. Germany, as well as some of the other large economies in Europe, are experiencing weaker GDP growth, and that's a main reason why the ECB is continuing to cut their policy rate. We also look at the wars going on, and we know that these wars have put strain on European business as it's led to higher energy costs and higher input costs. And we know that global supply chains have been disrupted. So there are multiple factors that have led to weaker economic performance in Europe, and that's why the ECB has switched to a looser monetary policy. It looks like they are planning to cut rates more in the near future, but there are many variables affecting their decisions. And if we do see inflation tick back up, which it definitely eventually will, it's going to be hard for them to be at a low policy rate, right? That's going to lead to rampant inflation, and that's going to mean problems for the euro. It's going to mean problems for their economy. And in the long term, like I said before, inflation is going to be the outcome in Europe, in the United States, in China, everywhere. All these countries and central banks are dealing with similar issues. To wrap it up for this video, this is obviously bearish for the euro and it's bullish for European stocks, at least for today. We saw how they performed. We'll see how European stocks perform over the next couple of months. I also think this is obviously bullish for hard assets like Bitcoin and gold, and you know how I feel about Bitcoin and gold, so we don't have to get into that today. That wraps it up for this video. If you didn't like and subscribe, please make sure to do that now. I appreciate your support. Thanks for watching. I'll be back soon.